Paul, I hope you're long stocks this week because we're getting ready to close out with some new highs. Tell me what you make of the reaction we saw post GDP throughout the session today. Is this what you would have expected if someone said, "Look, we're going to beat by a solid amount here"?
Actually, no. That's actually the reaction's kind of interesting. But I think if you take a look underneath the market a little bit, it is dominated by the tech names today. You've highlighted it earlier, and it is the case. NASDAQ certainly beating up on the S&P, which is beating up on the Dow. And when you look at the net number of advance to decline, it's barely 2 to 1. A little bit heavier on the NASDAQ, a little bit better there than on the New York Exchange. So although the markets are running pretty good, it's not a super broad-based rally. Much of this week we saw small cap underperforming. That flipped around a little bit today, but it's been dominated really by the big U.S. names, and certainly with the tech earnings from the last couple days, that only reinforced what we saw so far this week.
All right. I think it's very, very true. Big moves in the small caps today. We're looking at some of the breadth measurements here. Still looking solid. Not the loftiest we've seen this year, but definitely picking back up. Paul, what about some of the macro assets? Gold and dollar are kind of gained in harmony today. Any thoughts on that?
And that one is kind of interesting. When we take a look at the dollar, and you and I have talked about it for a little while, why is the dollar strong? Should it continue to be this way, especially if we're talking about interest rate cuts? But the dollar's really been in a pretty narrow range now for the better part of the last year, and it continues to benefit from negative interest rates around the world. The U.S. still has some of the better rate yields that we were seeing out there. As a matter of fact, Greece is now got a yield roughly equal to the U.S. 10-year Treasury. So the U.S. is still a good place to go for safety. And so I think that's what's putting a bit under the dollar. Gold, I'm not quite sure. It usually runs a little bit negative to the dollar here, and it's broken out really over the last month or so. And it could very well be the anticipation that interest rates coming down, maybe we do see a tick up in inflation. Maybe the Fed is misguided in their cut and could lead to something wrong happening. So there might be a little bit of anticipation on the gold side. Commodities as a whole running roughly flat year over year. So we're not seeing the inflation pickup yet from a lot of the commodity markets.
Yeah, I think that's interesting as well. I mean, it's been pretty muted there. Definitely not a big inflation number this morning from the GDP side, right? The deflator, I think kind of market likes that. Paul, when we look at the upcoming event for FOMC next week, let's take a look ahead because we've also got the employment for the month right on the back of that. We now still have a 20% chance of a 50 bip cut baked into Fed funds futures. And I'm curious, what happens in the market if and when we find out we don't get the 50 basis point cut. And many would argue that maybe on the back of this, we don't get a lot of chat about cuts to come. I mean, how do we get ready for this event everyone's been talking about for months?
Yeah, no, it's true. And I think what you're going to see is a lot of volatility from the time they make their announcement to the end of Powell's press conference. That will be a lot of fun for traders in the marketplace. But it's going to be interesting to see with the numbers that we got from durable goods yesterday, GDP today. Some of the numbers that we've been seeing are a little bit stronger. The argument can be pretty strong that they take away the December rate increase by cutting 25 basis points and sit on their hands for the remainder of the year. I think the equity markets could sell off over the next couple of weeks because of that, because I think they're anticipating more cuts to come. Cheap money is going to be good for the equity markets. Bonds are going to be a little different animal. We're starting to see yields pick up a little bit in advance of the meeting, which has been programmed to be cut. So that one's going to be kind of interesting. We could see actually yields pick up a little bit more as we go forward. But again, I think the equity markets maybe react a little bit negatively. But I can tell you, whatever the knee-jerk reaction is when they make their announcement, give it 24 hours, and I think we go the other way.